and also, I'd say, people conducting analysis on a bearish analysis or being negative about a company have less of an agenda than a lot of sell-side analysts who are perhaps persuaded to have a rosy picture about a company because the company might be a corporate client of the brokerage firm that they work for. So I think that, on the whole, bears have more of an incentive to get it right rather than sell-side analysts who are going with the crowd and are generally, with a lot of other people, benefiting. The whole system benefits long trades far more than it does short trades. So short analysis has to be a lot more critical, I think.
And it is the point, of course, that not only is your, as a shorter or as a bear, if you get it wrong, your losses are unlimited, you also have all the grief of being flamed on bulletin boards and getting lawyers' letters, which is unduly unpleasant. So generally, if you're a bear and you're not very good and you get it wrong enough, you're out of the game pretty soon. Yeah. The fact that you guys are still around, okay, baby's only 15, but the rest of you are still around at your, as you go into your 40s, suggests that you do get it right more often than you get it wrong. Matt, are we better than the bulls?
I think bears typically have more of an instinct as to if something is amiss with a company. They typically do more investigative work, I think. They're a lot more focused generally, and they're a lot more willing to actually not take things for granted, to go away and check, verify that that is the case, whether it's regards to the business model, whether it's regard to background of management, whether it's looking into the accounts themselves, and so on and so forth.
Graham?
Well, Tom, I'm actually a long-only fund manager, so I haven't had the opportunity to go broke yet by shorting. But it's true that history is littered with the corpses of dead bears. You probably saw the American youngster who started a GoFundMe campaign about 2 weeks ago after shorting a penny stock, which went up by several hundred%. So, I mean, the reason I have an interest in shorting is that I started looking for some deep value investments a few years ago for my personal portfolio, and I found that more often than not, there was a very good reason to be short the stock. In fact, once or twice I found that Simon Cockwell had shorted it for one reason or another. And so I think you need the bears to put the other side of the argument forward. As has been said, they have a lot more to lose, and so they're definitely worth listening to.
But we're not infallible. Lucian, I think probably the biggest disaster of the past year, well, we'll gloss over one little thing, but the biggest disaster, APR Energy.
Well, to give myself my due on that one, I did say originally start shorting it at £2 a share. This is a company that was eventually taken over. And that is an occupational hazard of being a bear. I pressed where the disaster was that I did press it, and I regret to say I exhorted other people to press the position at around about 70 pence a share, because it was clear to me that the company was in very serious financial trouble. This is APR Energy, the purveyor of temporary power units in places like the Yemen, Africa, Egypt, Libya, those sort of places.
Sort of places you send the mother-in-law on holiday.
Yes, yes. And a lot of the stock, their stock had gone missing. The auditors had said that they couldn't clearly go to a lot of these places where the stock was alleged to be. Anyway, the fact is that one of its large shareholders, and this is an occupational hazard that should always be borne in mind when being short a stock, a sinister organisation called Fairfax Financial, a large Canadian corporation that owned getting on for 20% of it, in order not to have to flush that investment down the toilet, made the economically wholly irrational decision with a consortium of other people to buy out the company for £1.70 a share. And this happens a lot, or enough for a bear to be to think about before undertaking a trade for a company that looks like a basket case. It happened, from my memory, with lastminute.com was taken out, Autonomy, of course, and Hewlett-Packard. It happens probably quite a lot, and should be enough to make bears think, it's an occupational hazard, and it's going to happen always, and there's nothing you can do about it. Otherwise, you never short anything. But the fact that Fairfax Financial will deeply regret buying APR, just as Hewlett-Packard did with Autonomy, is of little consolation. If you're caught the wrong end of the trade, you just have to grin and bear it and move on.
Okay, well, let's go why people are here. We've got 8 stocks which we think could all, or should all, or will all go to zero. They're not tiddly little stocks. They're all ones which are basically shortable. Maybe one isn't. But they're names that people should have heard of. Let's start with Matt. Tungsten.
Yeah,
Haven't we missed the boat here? The shares already collapsed.
They have collapsed. I mean, there's probably still further to go. Probably the common theme across all of these stocks that we'll be discussing is that they have an insatiable appetite for cash. And so
eventually you run out of other people's money.
Absolutely. You just have to do the mathematics and join the dots, and you work out just what the cash burn is, when they've got the account sign-off coming up, when they need to start, what they need to do to get those accounts signed off, how much they need to raise, what the dilution's likely to be. And therefore, you've got a pretty good chance of the stock going further down.
Tungsten got a rescue bailout away earlier in the year.
Yeah.
Odey backed that big time. How do you feel about the fact that we're batting against Odey, who is Crispin Odey, is a well-known fund manager. He's thought to be a lot cleverer than we are. We're batting against him, aren't we? Yes,
and probably will continue to do so, because typically the bulls don't give up that easily. I mean, there was a long-running battle many years ago with Pursuit Dynamics, where M&G constantly used to underwrite the regular cash raisings, and eventually that did collapse. You just have to slog it out to some degree, although what you do know is that each time they come to the market, there is going to be quite significant dilution.
In terms of tungsten, where we are now, the market cap is what is the cash, what is the cash burn, and I can't actually remember what tungsten does. It's a business model that doesn't work.
Well, it was a business. It's an electronic payment invoice provider, where the underlying business they bought, OB10, which had been jogging along for about 10, 12 years when they bought it, they paid £100 million roughly for it, 70 in cash, 30 in stock. This was a business that was on the brink of going bust, insolvency. They effectively rescued it. And they paid twice as much as what the cumulative losses had been involved in the business. As far as I can tell, that business, it's not gaining any market share. It's still racking up losses, maybe small break-even prospect. They bought a bank to attach to that for some reason, which was, in hindsight, looks totally misguided. Wasted the money on the bank. If the bank was of any value, someone would have snapped it up. So this argument that the bank has a value attached to it is a complete fallacy.
And what's the cash left now, do you reckon?
I think that they've probably got another 6 to 9 months cash to keep them going. It's just a question of what they need to do to get the accounts signed off.
So the only issue is if they have a calendar year end, by the time the accountants come round in March, if you think they've only got 3 months left, they're going to have, the statement's going to be qualified. So you'd think they either have to have another funding round. Is it possible that Odey will just say, well, actually, we got it wrong. Lucian Miers was cleverer than us. Marcel was cleverer than us, and not back the funding?
It's possible. I mean, it looks as though Odey have started selling down. Whether they're just selling down at 1 or 2% is
So if they're selling in the secondary market, the chance of them backing the next rescue bailout looks slim, and there is a very real possibility that tungsten not only runs out of money, but next time around, no one's going to back it.
That's quite possible, yes. I mean,
and that would make it a zero.
Yeah, I mean, let's not forget, the only backers in the last round were the major backers were Odey and Truell himself.
Mad Eddie Truell, the guy who set this load of rubbish up.
Yes.
So without Odey's cornerstone, it's possible there will be no rescue bailout. If there's no rescue bailout, by June next year, this is a zero.
That's quite possible. I mean, the argument, going back to what Lucian was discussing a while ago, where the threat is always there that someone buys them out. Typically also with these types of companies, there is always that risk there, but they don't generally get bought out by the big players because they're not really gaining market share. There's no evidence to suggest that tungsten is gaining market share. They are a huge drain on the cash, and those companies are always, the bigger ones, big boys, already in those markets, and so there's no real reason for them to buy these companies or pay a premium for them, other than to maybe wait for administration and pick over the carcass there. Okay, let's move on. Lucian, Avanti Communications, which is one that everyone here has been bearish about for a long time, and it hasn't quite collapsed. In fact, it's done rather well.
Well, I wouldn't say it's done well. Either by share price, certainly not in performance terms. The thing with Avanti is that the guy who runs it, Williams, is an extremely good salesman and seems to...
The only person in the city more bombastic than evil.
That's what I've heard. So every time Avanti runs out of money, he is able to raise more, both in the bond market and the equity market. The problem that he's got is that his business model doesn't work. His sales...
Avanti puts satellites into space which no one's interested in using.
That's correct. His sales are now stagnant. For 14, 15, and it looks like 16, sales are going to be bouncing around $60 million per annum. That is not enough to pay off his interest bill, even if he breaks even at EBITDA, which he's not at the moment doing. So, he's said, but he said before, he doesn't need any money, and then he goes out and raises it. This time he said, I really don't need any money. The money that we raised recently, 126 million plus a few £1 million of equity, will last us through to profitability. Now, like what Matt was saying about tungsten, is if a business model doesn't work, then you have to keep coming back again and again and again for cash. The sort of one last heave, one last time, and everything will be all right. The problem with Avanti is that its assets have a finite life. A satellite lasts about 15 years. So it's probably getting towards a quarter of the way through that, and they haven't anything like filled up capacity on them. So the question is, my opinion is that Avanti will go to zero, because I think sooner or later people are going to stop throwing good money after bad. The major bond investor is a guy who I think is completely mad, who has put in more and more money, a man named Reed, an American bond firm called Mars Capital. They're the cornerstone bond investor. On the equity side, you've got 10 big-name shareholders who own getting on for 65% of the equity. Why the share price is up where it is here, valuing the company at 300 million, I just don't know. But what I do know is that when these things unravel, they unravel pretty quickly. And I am confident that he might get one more raise away, but then the questions will be, when's the next raise and when's the next raise? And sooner or later, people will realise that just like tungsten, the business model doesn't work. And patience will be lost.
In terms of sort of red flags on Avanti, I would put 3 more to you all. The first is that, by his own admission, Mr. Williams misled investors when raising his initial money. He has boasted about how he did a demonstration of his product, which he in fact fabricated. Anyone who listened to the Sam Antar talk earlier is, once people admit they've done one thing once, then it's in their DNA. They're always going to do it. The second thing is that this company has missed its forecasts for revenue and EBITDA. The one thing you've got to give the guy, he's consistent. Every single quarter he misses his forecasts. That doesn't give you a great deal of confidence in the company going forward. And the third thing is that each time it produces its report and accounts, either Lucian or Matt says, hang on a second, this doesn't look right. I have this weekend written to the Financial Reporting Council, who, as you know, are my good friends after Quindale, asking them to investigate Avanti's 2014 accounts. The company declared that it had revenue of $85 million, and it booked a large EBITDA profit in the fourth quarter. Lucian, would you care to explain how it generated those $25 million of sales in the fourth quarter, which all came out through as operating profit?
You're talking actually about the year to June 15.
That's correct. I'm talking about the year
revenue
to June 15.
For the year to June 14 was $65 million. So, I don't know whether there was a bond covenant or what the reason for it was, but basically revenue to June 15 was $60 million. Well, that doesn't look very good for a company that's supposed to be growing fast and filling up satellite space. So, in fact, the revenue reported to June 15 was $85 million. 25 million of that was a very strange transaction, which I think is what you were writing to the
FRC about. That is correct, yes.
Well, the counterparty, it was basically a lot of spectrum that was unwanted by a large Belgian satellite company called SES. And it was, as far as I can see, more of a purchase than a sale, in that the money flowed from Avanti, or will flow from Avanti to SES. There is not a single euro or dollar going from SES to Avanti. But they managed to book this as not only a sale of 25 million, i.e. getting their revenue up from 60 in 14 to an impressive sounding 85 in 15, they also managed to book a large portion of that as profit. I don't know how, but they managed to.
So the effect of the transaction, as we understand it, is that over the next 10 years or so, Avanti will pay 13 million euros to the other side. That is, the cash is flowing from Avanti to the other side. But as it was booked in the Avanti report and accounts, it is 25 million of revenue and actually 25 million, it's 100% margin, of profit to Avanti.
You'd have thought also that if it was a sale by Avanti to SES, it would be booked in the SES accounts as a purchase. But they strenuously deny that that is how they booked it. Obviously, it's a much, much bigger company, SES, and it's difficult to extrapolate from their accounts. But certainly a spokesman from them has said that they would not in any way describe it as a purchase. It was basically an asset swap.
But obviously, we're not expert accountants, but we'll leave it to those good fellows at the FRC to decide whether Avanti's accounting treatment was correct.
But what it did was it masked a recurring revenue collapse in the fourth quarter from 17 million in the third quarter. This is a company that is supposed to be growing. $17 million in the third quarter to 11 million in the fourth quarter. Not a single analyst picked up on that because it was obfuscated by this sale. Now, that is a pretty dramatic decline in revenue for a company that has got a $60 million interest bill a year and is supposed to be filling up space.
OK, so we'll ignore the red flags. We'll assume that the FRC will find nothing wrong with Avanti's seemingly interesting accounting policies, and we'll ignore other things. In terms of Avanti going to zero, your scenario is that it fails to meet its whatever projections the bombast is coming out with, and it simply can't meet its interest bill within 12 months, 18 months. And at that point, it is possible that the people who've been bailing it out so far say enough is enough.
Well, people like Miers Capital, who incidentally also hold the equity, will have to protect their much larger debt investment and take the company over. The bondholders will end up controlling Avanti 100%.
So, in other words, this will be another Afrin-type scenario where the company's got so much debt, it can't manage the debt, and the bondholders will say, either we get 99.9% of the company and shareholders are screwed, or you're toast.
The other aspect is, Lucian mentioned the finite life cycle of the underlying assets themselves, where the clock's ticking on those. The clock is also ticking on, not only does Avanti have an insatiable appetite for cash, and it keeps having to raise more cash to service the existing debt, the clock is also ticking on that existing stock of debt itself. And so that will need to be refinanced at some stage in the few years ahead as well.
And that will be very hard if the company is toast at that point.
Well, the last time they raised debt, it was at 10%.
It would be considerably higher now.
Yeah.
Okay, Graham. FastJet, this is a company which David Lenegas is involved in, so it goes without saying what I think, or was involved in. It has the curse of Lenegas, so obviously that makes it a slam dunk sell. Is there a bit more to it? It's your first choice of a zero.
Yes. FastJet has been diluting shareholders throughout its short but entire existence. It was
company associated with David Lenegas issuing lots of shares. Well, there you go.
I don't think he's been directly involved for quite a while, but
he likes it on Twitter.
Right. Okay. No, it was a Lonro divestment.
That was Lenegas.
Yes.
Okay.
So it was a Lonro divestment in June 2012, and within a month they had a placing and arranged an equity financing facility. So FastJet.
By equity financing, you mean death spiral?
Well, yeah, a perpetual drawdown.
Death spiral. Okay, yeah.
So they had 3 planes in Tanzania, and they've become the largest airline in Tanzania, but have had such an insatiable need for cash that anyone who's been in it since June 2012 owns less than 5% of the company now. And the really scary part about it is that their ambition is to become the biggest low-cost airline in Africa, and they're competing head-on with flag carriers, usually owned by owned 100% by the national governments, except in Tanzania. But they fly to South Africa, and they're looking to fly to Kenya. But I mean, it's very interesting because obviously it's a story stock. But when you try and work out what is the size of the story, I mean, the 5 countries that they currently fly to have an entire GDP less than that of Detroit. And, they bought a plane, nearly a 10-year-old plane with 3 previous Chinese owners to set up new flights in Zambia. But Zambia's GDP is less than that of Leicester, for example. So it's not a very exciting story when you start thinking about like what could they potentially become down the line. But more pressing than that is the fact that they burn so much cash, and they raised £50 million in April. Which is $75 million. They bought a plane, they leased 2 new planes, and I mean, if you look at their load factors, for example, their load factors have declined to 60-something%, 63% in their sort of core Tanzanian operations. And a normal low-cost airline, Ryanair, EasyJet, is looking for 90% plus. So it's not possible to have a profitable low-cost airline. Those load factors are declining. And I did check on Expedia, I checked online, and they are definitely the cheapest. But it's an example, I think, of selling £1 for 90p. But in this case, there aren't enough buyers. There doesn't seem to be the demand on the ground. And I think it's almost certainly a zero in due course.
The market cap is 40 million at the moment. Presumably, having raised that money earlier in the year, they're not at death's door at the moment. They have quite a bit of cash left.
Well, let's put it this way: they've spent 15 million on a plane. So $70 million. They spent 50 million on a plane. They probably, let's say, they lost $10 million in H1 in Tanzania. The passenger statistics have got worse since then, and they've announced that next year they won't be announcing passenger statistics for competition reasons, which might be true,
right?
But is not.
But in case other people are drawn into this obviously money-making machine of a market.
Yeah, no, they say as they expand into more and more territories, they're worried that the local government flag carrier will be able to see what they're doing, I suppose. So,
so by your maths, the company's pissed away at least, by Christmas, will have pissed away at least half of the money it raised.
Yeah, well, it's hard to tell exactly. Their Zambian operation is not live yet, but they bought a plane for it. The Zimbabwe operation was delayed. They leased a plane for that. So I would say within, if we come back 15 months from now, the vast majority of that money should be gone.
Okay, and then it's a matter of whether the market wants to bail it out another time. And just that may not happen. Okay, now one from me. He's made a bit of a pointless one, but as Evil says, the best time to kick a man is when he's down. When Quindell sold its businesses to Slater & Gordon, shares in Slater & Gordon, the Aussie law firm, were $8. I think they closed on Friday at 64 cents. It has been a catastrophic acquisition for Slater & Gordon. I reminded people that they should be short of the stock about exactly a week ago today when the shares were $2.50. I did so because the company had basically served up a trading statement which was pretty grim. It admitted that they burned, I think, 40 million of cash in the, they were going to burn 40 million of cash in the first half of this year. They have a June year end. On that basis, it seemed to me, just looking at the research put out by paid-for research Edison, so they do exactly what the company tells them to do, that the company would, by June 30th next year, be out of money and drowning in debt. That was enough. I was pretty convinced at that stage that Slater & Gordon would go bust. Its problem was that it took on a vast amount of debts to buy the fraudulent operations of Quindell. It didn't need to. Quindell was bust at the time Slater & Gordon had bought its legal services division. If Slater & Gordon had gone in and paid 50 million quid for those businesses rather than 647 million, Quindell would have had no choice but to accept that because its banks were wanting their money back. Quindell would have had to say yes. Slater & Gordon knew that, but still decided it would pay £647 million instead. That showed that its management team were completely insane. I think what it showed also was that this was all about stock promotion. If they'd said that Quindell was only worth 50 million, given that Quindell was forecast to make 60% of the enlarged group's EBITDA, then it was suggested that the whole group, or the existing Slater & Gordon businesses, were worth perhaps 50 million quid, call it 100 million Australian dollars. They were, before the deal, capitalised at $800 million. It would have been an admission that their own stock was overvalued. So the management team in this company was clearly insane. That's always a good red flag. They paid 650 million for what is now universally agreed to be a complete fraud, and a fraud that never generated a cent of cash. The profits warning 10 days ago admitted that they were burning cash on the UK operations, and it seemed to me then that it was clear that Slater & Gordon would run out of money by the middle of next summer. As an added bonus, the Chancellor, in his autumn statement, has said that all personal injury claims under 5,000 will now go through the small claims court. You won't be using a lawyer. That has wiped out, that move will wipe out not only 95% of Quindell's fraudulent UK business, but also 95% of the business of Slater & Gordon UK. Slater & Gordon is a massive UK firm. That ensures that the company, which will probably be insolvent by June anyway, will certainly be insolvent a few months later. The whole industry has been decimated by this change by George Osborne. If you are a lawyer working in that sphere, you cannot now get redundancy insurance because law firms are just going to be winding down. It is toast for them. Slater & Gordon is toast. I think we probably all agree that Slater & Gordon is the surest fire zero of the stocks we're discussing.
Pretty certain, yeah.
It is a total zero. Slater & Gordon will be zero by June at the latest.
I mean, it's one of those great examples where what Lucian again was mentioning earlier about where a company gets taken out, and what can you do if you're short on the stock?
Quindell would have been a zero had Slater & Gordon not been certifiably insane.
But it's a great opportunity to roll your short over,
Indeed.
which unfortunately doesn't happen that often.
Was it iSoft was also, but worth nothing, was taken over by an Australian firm, which then went bust?
Yeah, yeah.
The other one in that category, of course, is Rob Terry's second fraud. Quindell was his fourth fraud. Rob Terry's second fraud was a company called SQS, I think, which was taken over by a Canadian company, Lava. Within a year, or within a couple of weeks actually, Lava had realised that Mr. Terry's sales pipeline was completely fictitious. But by that stage, it was too late because they'd handed him the cash. And within a year, Lava was put into administration too. So that would be the idea of a fraud being rolled into another company and bring it down. And a happy thing that Rob Terry was involved in that as well.
Tom, I might just give credit where credit's due. I think the Quindell sale was a fantastic advertisement for the British financial industry and their ability to sell companies.
Right, okay. Okay, right. Let's go back to Lucian. Plus 500.
Well, this is not so much, I mean, what we've been talking about, obviously, for companies going to zero, the running out of cash is very important. Plus, I think Plus will eventually end up being a zero. Cash is an issue, but not the biggest issue. The issue is regulatory. That they've been quite fortunate with the collapse of this bid with Playtech by basically allowing the notion to pervade that it was Playtech's problem, not Plus's problem. Playtech also failed to take over the Irish company that it was interested in. And the word has been sort of put around that the reason for the failure of the 400p cash bid for Plus was that there's a lot more scrutiny needed, and these guys are up to running betting firms, but not up to running financial betting firms. I think the problems are a lot deeper than that. Plus have admitted that they've still got questions with the FSA, which they've got to answer. There's an enormous amount of scrutiny now on spread betting firms. Their margins, they showed in their interims, are suffering badly, with not just because of the investigation, but because of the industry generally. Their cost of acquiring clients are going up. And what they have admitted is critical is the acquisition of high net worth individuals, i.e. customers with, sizable, prepared to put in sizable amounts of money. Well, if any of you look at the Plus 500 website, it's just not geared for that. It's geared for taking very rapidly small amounts of money off very small, unsophisticated punters. The interface is absolute rubbish. I would bet that nobody in here has an account with Plus 500, and if they do, it's probably just to track and see how they do against the opposition. It's a very, very unsophisticated form of removing money from small, unsophisticated punters to the shareholders of Plus 500, and it's worked hitherto. But I think with the scrutiny with the Playtech bid, the questions being answered, the fact that a lot of the accounts were closed for a large chunk of the summer, suggests to me that this business is going to be in serial decline now. People are onto it. Eventually, if you make money, companies make money by stealing, maybe too hard a word for it, because these clients are all willingly giving their money, losing their money willingly, or willingly at first to Plus 500. But when you make your money basically by ripping off your customers, as Cupid showed, which I think we talked about last year, the business is not sustainable. And so therefore, not for immediate cash concerns, they're about to buy back their stock and pay a 20p dividend. I think the Plus 500 business model is unsustainable. And I know that they give a lot of money in advertising to ADVFN. But that having been said, I think their business is doomed. They
pay a lot of money to advertising to vast numbers of people, which comes back to the cost of customer acquisition.
Which is going up, which is good for the...
It's good for ADVFN, yeah, absolutely.
I don't think it's sustainable, and I don't think Plus 500 will be around. And I think, the danger I was talking about earlier about somebody coming in and bidding for it, well, that's happened. Been there, done that. Who's going now to bid for Plus 500 when Playtech have been forced to walk away from it? So the fact that Plus 500 management were prepared to sell their company for 400 pence, having seen them at 800 pence, and quite happy to take the cash. These guys aren't mugs. The fact that they're 404 pence now suggests that it's not a bad short at this point.
Presumably, though, the share buyback, 20 million share buyback, will support the share price short term.
Short term, it'll probably bobble around here for a bit. They'll then go down the 20 pence when they go ex-dividend, and from there, I would think they'll continue.
Presumably, isn't Mr. Odey a big fan of this one as well?
Yes, he is. He's got a big stake in it. And when the bid came from Playtech, he said it grossly undervalued the company because I think his average is a lot higher than 400 pence. But he was overruled by the management who control the company. And I don't notice Odey Asset Management showing any interest in acquiring stock in the last few days.
Well, maybe all those shares they've sold in tungsten, they can reinvest in that. Matt, one disco.
Yeah, this is quite a simple short, really. I mean, just going back to the theme of mathematics, it's
running out of money.
Yeah, absolutely.
But it's involved in big data.
Well, yeah.
Big data. Everyone's, you can't lose money on big data.
It has been for a number of years, and
speak to a young person. Big data is the new thing.
They're not alone in that. There are many, many other companies involved in that.
But it's a big market. It's the new hot thing. Everyone's going to make money.
It's a big market. Maybe one of them will buy it. But it goes back to my point about I don't think they have particularly much in the way of IP. If they do, I think it could be protected in much of a measure. If anyone is interested in it, they will probably look to go over the pickings in administration. As it is, it doesn't seem to be disrupting its market. It doesn't look as though it is gaining market share. It's growing, but at not a particularly strong rate commensurate with the valuation. And in the meantime, it is burning all that cash.
It's had about 2 or 3 earnings revisions on the downward side over the past year.
Yeah, I mean, I'd be very circumspect about its funding with regards to the HSBC facility.
Oh, yeah, this company has a 10 million loan facility with the HSBC. What they haven't told the world, although I did it for them, is that is not just an overdraft facility. That is money which can only be drawn down as working capital on specific projects. So the real question is, what is the cash position? From memory, it's not a lot.
No, they would, without a doubt, have to raise cash, I suspect, by January this year. The books are closing, or their full year is the end of December. If it's anything like last year, they will, in the interim between having the books signed off by the accountants in March, whenever it is, they'll have to raise funds to remain a going concern. Their cash burn is of the order of about $20 to $25 million a year. So at the current market cap of whatever it is, about 35 million, you're probably looking at dilution of at least 50%.
What is the share price now, from roughly?
Is it 140 or something?
140. The last fundraise wasn't that long ago, and that was at 185.
Yeah.
And there was a fundraise much higher, because the shares were 12 quid. So presumably those people who've taken a beating so far won't be rushing to get the checkbook out.
No, absolutely not. I'd also, as circumspect as with the HSBC facility, I'd question kind of the contracts that they've got as well. With software, there's very few companies that have software contracts that run beyond a year, and yet they have capitalised quite a lot of deferred income accounts receivable related to long-term contracts, and whether or not they are actually as secure as the company may suggest they are is questionable.
So for One Disco, the question is, can they get a refinancing away in January? And if they can't, they're toast. And if they can, given the current market cap and the cash needs the business clearly has, one would doubt that they're going to raise enough. It's therefore going to be a hugely dilutive, not raise enough placing, and that only postpones death by another year. Yeah,
absolutely. I mean, they're either looking at a mammoth raise that they will need to last them for at least a year, 2 years, or it's a death by 1,000 cuts going forward.
But either way, in the long run, if they can't generate cash, they're toast. And all the evidence is that they missed so many targets, they're not going to generate cash.
No, absolutely, yeah.
Graham, AO World.
Okay. I don't think...
This is a joke flotation, wasn't it?
Well, it was a...
Selling fridges online or something.
It was a 2014 flotation, and there was a lot of junk in 2014. I don't think this company is in distress, but I just want to express skepticism about the business model and where they're heading over the next couple of years. The market cap is 600 million now. They have a good position in the UK in terms of market share. They're competing head to head with Dixons, with Currys. But what they're trying to do is to become the biggest online retailer of these types of goods in Europe. So they've got their hub and spoke model, which they've rolled out in Germany, and which is now extending to the Netherlands. But this is consuming cash at the rate of about £9 million in the last 6 months. And what's worrying is that while this is consuming cash, their UK operation is seeing its own margins decline, so that the cash generation in the UK was in the most recent interim results was very, very low. It was about less than 2 million. And so I think this is a distributor which has a huge amount of empty revenue. That the whole concept of doing things that nobody else is doing because nobody else would want to do them. And I think shareholders were very optimistic at the flotation, but if you look at the accounts, they've grown revenues in the UK by £200 million over the last two calendar years, or the last two financial years, from 270 million to 470 million. And in that time, their operating profit barely moved in the first year, and in the second year it went up by 3-4 million. And that's if you strip out the sort of the share-based payments charge and the sort of the IPO costs and all the exceptionals. So they're one of these companies that reports adjusted EBITDA margin, which is not a Warren Buffett indicator, and
EBITDA is bad enough, but adjusted EBITDA is profits ignoring loads of costs and then ignoring some more costs.
Sure, yeah. And I think there's possibly a credibility issue as well, because when they reported their full year results earlier this year, they talked about their this EBITDA margin had increased to over 3%, and they were talking about how they were benefiting from operational leverage. They were going to be able to leverage up their selling and general expenses. But then, in the most recent interims, which explains the recent share price fall, this margin came right back down below where it had been the prior year, which sort of says that this operational leverage might exist, but it doesn't exist yet. And so their only real, their game plan is to try and become the Amazon of white goods, or to get so much market share that Dixons or somebody will have to take them out. But it looks as if they simply don't have the operational leverage yet.
What's the cash position?
They had £30 million most recently, but they stated their intention that to continue what they call the P&L, the net P&L investment, meaning that to continue.
Their intention is to carry on burning 9 million a half year.
To continue expanding in Europe, and my concern would be if the price of fuel goes up, if consumers sort of become less buoyant, if Dixons starts being a little bit more aggressive, and Dixons has a price promise against AO. So AO's pricing strategy is very simple, just to be the cheapest. I think that's a terrible pricing strategy on its face. But Dixons offers to match them. So again, the sum total is I don't see a competitive advantage If AO World never existed, should it have been invented? Probably, in the UK at least. They've been reasonably successful, but in terms of stealing market share, but they're not very profitable. And their H1 UK revenues didn't increase by very much, increased by 14%. So if revenues are increasing at that rate, if the margin's declining, what sort of multiple does that imply for the UK business? And then you subtract the extraordinary risks faced as they expand through Europe. So it looks very scary to me.
Okay. We'll end with one from me. Gulf Keystone. I think we were first started being bearish about this at about 180, Lucian, didn't we? And
a bit higher than that.
It was a bit higher than that. And it was, at one stage, the bulletin board darling. God, they hated us when we said it was a sell at 180. The shares closed Friday at 24p. I have this as a 0. The company is not generating cash. I don't know if there was an announcement on Friday. I didn't see one. But for the past 2 months, the Kurds have been paying over $15 million a month. That's a net $12 million to Gulf Keystone. If they carried on doing that and Gulf carries on not spending anything on CapEx, it will still breach the covenants on its bonds, that is to say, go to a net cash position of less than $6 million round about this time next year. So that would put it in default on its bonds. It's got something like 550 million of debt, 600 million of debt. It's got vast amounts of debt which it has to start repaying in 2017. There is not a cat in hell's chance of it repaying that. If the Kurd government is actually a bit slow on its payments, then it will breach its bond covenants before November next year. There are, of course, geopolitical risks in operating in the Kurdi region. ISIS seems to be in retreat, but you never know what's going to happen. Such a disruption would be awkward. The bottom line is that in a best-case scenario, this company will certainly be in default on its bonds in a year's time. That is the best-case scenario for shareholders. The worst-case scenario is it could happen at any time soon. If they don't get any payments in, their last stated cash position was about 46 million. If they don't get any cash payments in, then they could go through the banking covenants pretty soon. One thing to note here is that there are two classes of bonds. One is trading last seen at 39p in the pound. Another one is trading at 60p in the pound. That means that the yield on those two bonds is 17% and 21%. If investment was terribly easy, we'd all just go out and borrow money on our credit card and buy Gulf Keystone bonds, and we'd still be making money. Clearly, it is not that easy. The fact that the bonds are yielding so much, the fact that they are trading at such a huge discount, tells you that bondholders accept that they are likely to take a haircut on this company. If they are likely to take a haircut on the company, that means that the equity holders are certain to take a haircut on this company. So I would put it to you that the equity, the fair value for Gulf Keystone shares is 0p. Right, we're a little bit over time, so I'll just ask one final question. Excluding Slater and Gordon, which is the most obvious 0, what would be your top 0 for the next 12 months? Graham?
Fastjet. Fastjet.
Fastjet?
Yes, if it can be shorted, it may not be very easy to short.
As it's a David Lenegas tainted stock, I'm almost with you. Lucian?
Well, I'd say June of next year, which is not obviously a lot less than a year away, that KPMG, the auditors to Avanti, are going to have to think long and hard about signing off a going concern statement on the basis that I don't think they'd have cash to last a year. So either they have to raise a lot more cash at a huge discount to the current share price, or they are a 0. And I would think the latter will apply.
Matt?
Yeah, I agree with Avanti. I think if not 0, then it's going to be a very, very fast downward spiral to pennies.
Okay. Thank you very much. I hope you enjoyed the talk.